Tuesday, December 10th, 2024, Maneko64, home of alternative economics and contrarian views. So we're going to look at China today. Has China just come up with its whatever it takes statement? And what does that mean? Well, this refers back to Mario Draghi, the president of the ECB, back on July 26, 2012, when the euro was in danger of collapsing because of the sovereign debt crisis that enveloped Southern Europe. He came out and said, we're going to do whatever it takes, or print, right? Is China in such dire straits that they need a whatever it takes moment? I don't think it's as bad as the EU or the Eurozone back then, but that's what we're going to look at today. Before I do, I like to make a couple of announcements. One is about Glint. Many of you know about Glint. Glint is a way of buying gold through an app. And what Glint does, they store your physical gold in an allocated vault in Switzerland. And they also provide you with a MasterCard, which allows you to spend your gold. You can also keep your funds in dollars, euros, or pounds in the app, exchange it to gold. And yes, it's a fun way, in my opinion, of having some gold and being actually able to spend it. Is that the way I think people should accumulate gold? No, but I think it's something interesting that could evolve. And I just wanted to announce that they have now launched a function in which in the app where you can buy silver. The only difference with the gold function is that you won't be able to spend it on your card yet, and you won't be able to exchange it for gold. You can only exchange it for the fiat currencies, but if you want to buy silver through Glint, you can now. And for my UK viewers, no, there isn't any VAT when you buy it because it's in an allocated account in a vault. And unless you take delivery, which you can do, you won't pay the 20% VAT tax on it. So if you want to find out more about it, I've got a link in the description below if you don't have a Glint card or a Glint app. And I have a referral code there. And you can go and check it out to see if you're interested. The other announcement I wanted to make is that I've got a link as well for Wide Awake Clothing, and I really enjoy their stuff. They say here, thought-provoking designs to awaken sleeping minds. And they've got a Christmas sale on, 15% off everything for the rest of December. And you can see the kind of t-shirts and sweatshirts or hoodies that they sell here. So, back to China. So, there's an announcement yesterday, and it came out pretty much when I was preparing for my video yesterday for my report. And I didn't talk about it, but I think it's very significant. Is it going to be China's whatever it takes moment? I don't think it's going to be as serious and as big as the Eurozones at the time. Yeah, the Eurozone countries like Portugal, Italy, Ireland, Greece, and Spain, their bond markets were collapsing. The euro was on the verge of collapse. I was still working in the city of London at the time, and I remember talking to one of the bullion dealers that I used to buy some coins from, and he was actually a jeweler in the city of London. He had very good prices, John Haynes, and he said he heard from his contacts that the German Bundesbank and the German government were working together to print Deutschmarks. And I think they printed Deutschmarks to be ready to circulate the currency, the old currency, in case the euro collapsed. So it's very serious. So yes, I think this is significant what China is doing, but I don't think it's going to be, it's not a response to such a serious crisis. And I think, unfortunately, the Chinese government establishment or economic class and banking class, they've been affected by the Keynesian mentality of the West. And what's that mentality, in my opinion? Well, they're very much scared of what they call deflation. And by that, I mean prices that are not rising that much, like the Chinese CPI, for example, has been rising at just 0.2%, and that's not month on month, it's year on year. And they see that as a problem. I don't see it as a problem. I see it as the currency keeping its purchasing power. But I can understand, I guess, why the Chinese would want to lift the CPI maybe to 1 or 2%, because it has to compete with the rapidly depreciating dollar and all the other currencies around the world. I mean, you can bet that if CPI in the West gets to near zero or negative, there will be panic from the Keynesians. So I want to say that before I start looking here into this, that I'm not into this Keynesian philosophy, and I think it's the wrong thing. But I'm not surprised that China, being like a centralized, more communist system, actually it's a hybrid system. You know, they wouldn't be purely communist. I would say, if they were purely communist, you wouldn't have seen China bring so many hundreds of millions of people out of poverty in the last 30, 40 years, but that's a different topic. So what is really deflation? In my view, in my contrarian alternative economic opinion, well, if you look at the classical definition of inflation and deflation, it's basically we'll start with inflation. It's the increase of the money supply out of thin air. And what does it mean, out of thin air? Well, when the banking sector, commercial banks, or even the central bank create reserves or money with no backing. In the old days, before central banks and fiat money, inflation would have been done by debasing the coin. So the Romans did that with the denarius, of course. By around the 4th century, there's hardly any silver left in the denarius coins. Britain did it in the 20th century. They inflated the money supply through the silver coins. How did they do that? Well, after World War I, British coins, instead of being 925 silver or 0.925 or 92.5% silver, they became only 50% silver. So if you had £1 million in silver coins before World War I, that became 2 million. They inflated the money supply, and that's why we had a lot of inflation. We've had a lot of inflation in the UK since World War I, really. After World War II, they did more inflating through the silver. And what do? They actually just took all the silver out, so the coinage supply could become infinite in terms of just copper and nickel. And that's how they do it. But nowadays, it's done through the loans in the system, through government borrowing, through central bank QE or money printing. And that's how I see inflation. And it usually leads to rising prices, but of course not of everything. But they've, the powers that be, the bankers who control everything, really, academia, the media, they've led us to believe that CPI is inflation. And the same goes for deflation. Deflation, of course, is when you decrease, it should be when you decrease the money supply. And I would say that deflation was almost impossible when you had sound money, or even in Rome, because they didn't want to give people more gold and silver on the coinage. There was a limit. So in this current system, what they call deflation is, of course, prices going negative, which is would be the consequence of deflation. So let's go through this article here in the FT about what China is doing, and then we're going to look at Chinese M3, and we're going to look at US M2, and to see whether we're really in trouble of having deflation, and why I think what China has just announced is going to be even more inflationary in terms of helping commodity prices, helping, unfortunately, the cost of living to stay high, not just in China, but in the West. And it's another signal to me that commodities are on their next leg higher of a secular bull market. And I spoke about this some days ago or a week ago or so. I'm going to put a link to that video up here in the cards. Actually, it was Saturday, just a few days ago. So this is another confirmation here. So yeah, it came out yesterday. FT, China loosens monetary policy stance for first time in 14 years. Markets rally as Communist Party officials to meet in coming days to discuss country's economic policy. So it's interesting how China, their government combines monetary and fiscal policy. Yes, they have a central bank, but they all work together. In the West, the central banks are independent, and we're led to believe that fiscal policy is for Congress or Parliament, and monetary policy is for the bankers to decide. Yeah, so it's a little different, but anyway, it says China's leaders have changed their stance on monetary policy to moderately loose from prudent for the first time in 14 years. So yeah, that's a long time. That's since 2010, sending stocks and bond prices higher as investors bet policymakers were taking the economic situation seriously. The announcement on Monday from the Communist Party's Politburo, which is headed by Xi Jinping, comes as leaders prepare to hold an annual meeting this month to lay out the economic agenda for next year. The Politburo says authorities must implement proactive fiscal policies and moderately loose monetary policies. It added that authorities needed to strengthen extraordinary, so they use the term extraordinary, according to someone from Morgan Stanley. That's the first time they've used the word extraordinary in this context. Extraordinary counter-cyclical adjustments and vigorously boost consumption, improve investment efficiency, and expand domestic demand in all directions. So purely Keynesian. I'm not saying I agree with this. I'm just trying to tell you how it's going to affect not just China, but the whole world. Don't forget, China is the second biggest, if not the biggest economy in the world, really, if you look at it in terms of purchasing power parity. China's 10-year bond yields fell to a record low of 1.92%, continuing a sweeping rally and defying warnings of a bubble in government bond prices. Bond yields move inversely to prices. So yeah, as you see, China is not in trouble like Europe was back in 2011, 2012. People are still buying the government bonds. Yields are not going through the roof. Hong Kong's Hang Seng China Enterprise Stock Index closed up 3.14%, after the policy announcements. So I'm not going to go through what Brown Brothers Harriman thinks, because they think it's the right thing to do, of course. They think there's a debt deflation loop. The guy from Brown Brothers Harriman, an analyst. China last adopted a moderately loose stance in late 2008 after the global financial crisis, and ended it in late 2010. So what happened to commodities after that? Well, up until 2011, well, they made another leg higher. Yes, commodities failed to go through the 08, 07 highs, the CRB, but gold, for example, went from a deep correction after the Lehman collapse from 1,000 to, let's say, 680, went all the way to 1,900 by the summer of 2011. So keep that in mind. That's why I think we're going to see continued strength, not just in gold and silver, but also commodities in general. The change of stance on Monday was taken by investors as a sign the leadership was taking China's economic problems more seriously. So I'm going to stop right here. You get the idea of what they're doing. And the thing is, they've got a lot more to announce this week. This was just a pre-announcement. So we're probably going to find out what it really means, this extraordinary change and the moderately loose monetary policy. So let's quickly look at China money supply M3. And this is from Trading Economics. And you can see that from around 2009 or October 2008, end of 2008, the rate of increase seems to have picked up. That was the last time they kind of came out and increased money supply, or the monetary policy. They loosened it moderately after the 08 crisis. So you can see that M3 has been growing. It dips like seasonally, it looks like, but the trend is always higher. That's the Keynesian mentality there. So there, as you can see here, there's no real danger here of deflation. And here's the US M2. We don't have M3 because for some reason the Fed thought it didn't want to publish it anymore. I think it was in 2005 or 6, around that time. Yes, M2 did start going down after the middle of 2022 as the Fed started tightening. But you can see that it's been growing quite a bit now, and we're almost back to the levels that we saw, the top that we saw back in early 22. And look at the increase we had from 2020. It was a massive increase in the M2 money supply. And is it any wonder we had rising prices or the CPI went up so much? And they called that inflation. No, but the inflation was the increase in the M2 that led to higher prices. But they don't want you to know that. The dollar in your pocket, the pound in your pocket, the euro in your pocket is going to be buying a lot less in the coming years, even though the central bankers and the economists and politicians are going to say, oh, look, we've got no inflation. It's just running at our target of 2%. And in the meantime, of course, the majority of the public are going to be hard up. The cost of living is going to keep going up. Same thing for China, but at least in China, the government encourages people to buy gold. With that, let's quickly browse here at the markets, see where we are this morning. We've got spot gold at 26.63. High's been 74, which was very near the high of yesterday of 76. So gold is picking up again. We're up about $3. Silver got back up above 32 yesterday. Of course, during US hours, it drifted lower, but I think underneath the surface in the fake COMEX, LBMA paper market, there's trouble. I read something about this exchange for physical contract being in high demand. So maybe someone's trying to cover their shorts. We'll have to wait and see. Right now, silver's at 31.83. It's unchanged. High's been 32.07. Low has been 31.70. Dow futures is virtually unchanged. NASDAQ 100 is down 27. S&P is down 4. The currencies are, virtually unchanged as well. Crude oil is down slightly. So not much else to talk about here. In terms of the bond markets, we're seeing the 10-year yield continue to drift higher. We're at 421, up 1 basis point. The 10-year gilt yield is at 434. So the gilt market and the treasury market are under control right now. And what do I mean by that? Well, their yields are kind of topped for now, but we need to keep an eye on it. The higher the yields go, the worse it is for the financial system, for the economy, because it means the cost of borrowing goes up, not just for the government, but for the whole economy. So with that, I'm going to wish you all a very good day. Take care. Bye.